Santoli's here talking about, well, the bank stocks in light, of course, Citi's earnings this morning. And it says here why may be the time to get in now?
Well, why they look relatively cheap, but they have for some time. It's just become more extreme. So we can kind of slice this a few different ways. The financial sector backing off a little bit today, a bit of a sell the news response after a strong run on Citigroup's earnings. Look at the way that the group splits, though, according to different subsectors. So the XLF obviously is the overall financial sector spider. It's up 4.5% or so in the past 1 year. This is a 12-month chart. What's interesting about this, though, is KIE is the insurance stocks, up 15% on a one-year basis. They've been leading. They've been bolstering the entire financial sector. KBWB is the big banks. KRE is regional banks. They have obviously lagged. So when you talk about financials, you're not really talking in some about the banks. And as I always like to point out, the XLF, the S&P financial sector, 12.5% is Berkshire Hathaway. That is not a bank. It is partly an insurance company, but whatever it is, it's not purely a financial. But look at the relative valuation. This is the KBWB, the KBW Banks Index ETF, the forward price earnings multiple relative to the S&P. It's, as I said, been cheap for a while. We've never gotten close to a market multiple this entire cycle. But look at it now. It's just over half the valuation. Two things going on here. The S&P in general is getting more expensive as the rally has gone on. And these banks are not moving in terms of valuation, guys. So it seems as if the bull case is just what you saw with Citi. Cost control, buybacks, and steadiness on credit. In other words, it's not the end of the cycle, so therefore credit's not going to become too big a problem.
Why the strength in insurance? Is it a lack of
Very good
events?
question.
Because they're all hunting for
actually,
yield.
Life insurance is in fact the best within it. So Contessa has all the answers as to why the insurance stocks.
Well, you know, I'm newly assigned to the insurance beat, so don't take this as an expert. I'm just learning about this particular field. But it's so interesting that that property and casualty is seen as a safe haven bet. And so what you're seeing right now is people trying to make money on the life insurance, and their investment arms of this life insurance is the big driver there.
And the bond market has been strong. They kind of own huge portfolios of bonds. Normally, though, the 10-year yield would have to go up for the insurance stocks to do better, life insurance. But the very, very long-term yields have held up better, right? So 20 and 30 years, they buy these things. It's hard to know exactly why, but it is a bit of a haven, and they're steady as opposed to what's perceived with the banks.